Hey guys, this is Nathan Thomas. Little training here again on concepts in the house. Um, as you guys know, one of our bread and butter leads that we work are mortgage protection leads, and there's all different scenarios that we can have. We can be dealing with young people that are healthy, young people that are unhealthy. We can be dealing with young people that have small mortgages, big mortgages. We can be dealing with middle-aged people, or we can deal with older people with big or small mortgages. So there's a couple basic things I like to do to approach any of those. And one is referring back to the Little About You page. I'm going to just hit this real quick because this goes into part of this presentation. One of the things I'm going to cover, one of the biggest obstacles that most people have is when you have older clients, let's say folks are in their 60s or even 70s and they have a $200,000 mortgage and they want what they want, which is $200,000 of coverage. So I'm going to talk to you a little bit about a couple ways of talking about how to overcome that and offer them something that's still as valuable as possible. One of the things I do when I'm talking to the clients, one of the concepts I'm going to bring up is I'm going to let them know that the system is set up to protect the banks. Would you guys agree with that? That the system, our economic system, protects the banks? Banks really don't lose. Would you agree with that?
Yeah.
Okay. So I'm going to talk to them a little bit about the bi-weekly mortgage payment. I'm going to show them, and if you don't know what that is, maybe we'll do another training on it later. But kind of understand that concept. It's where they can pay off the mortgage early. The average 30-year mortgage, they pay off 7 years early just by paying half of their payment every 2 weeks. But I'm also going to, on all these clients, I'm going to draw out their amortization. Before I do that, let me ask Vio and Shayla just a couple questions so you guys can see what information I use on that. Okay, so Vio and Shayla, what do you currently owe on your mortgage, approximately?
Currently we owe about 186,000.
Wow. Beautiful home you have, by the way.
Thank
Thank
you.
you.
Okay, how many years is that mortgage?
It's a 30-year mortgage, but we only owe 25.
So you've already paid it down 5 years.
Yeah.
Right.
Very good, okay.
Mhm.
So it's 25 years left. What is your monthly payment?
It's about 1650.
Okay. Does that does include taxes and insurance?
Yes.
Yes.
Okay. All right, let me ask you this. Currently, what is the approximate value of the house?
Well, we got it appraised not too long ago, and they marked it around 250,000.
Okay. So I have to do math in my head real quick.
Mm-hmm.
So 250 minus 186, that's what your equity would be. That's going to be $64,000, I think, something like that. Does that sound right?
Mm-hmm.
Yeah.
So approximately your equity is $64,000. You guys know what that means, right?
Yes.
Okay. So that's congratulations on having that much equity. You know, right now after the whole housing disaster, still a lot of Americans don't have much equity in their houses. So that's great that you have that. That's an asset for you guys. Okay. So typically I would do this on the back of this page if I can't do it because of the marker. So I'm gonna just pull out another piece of paper here. So let me just illustrate a couple things to you guys real quick if you don't mind, okay? I'm not sure if you're aware of this or not, but this is how your mortgage works. You owe 186. We're gonna call right now year one because you owe 25 more years. So you're really 5 years into your mortgage, but it's 25 years left. The average 30-year mortgage, the what you owe really doesn't go down much the first 11 years, but you're 5 years into that process. So the next 6 years or so, if you pay your minimum payments, it's not going to go down a whole lot. It's going to go down some, but then it's going to start tapering off, right?
Mm-hmm.
Excuse me for my lack of artistic skills, but I'm just trying to illustrate a point. But the nice thing is that it is going to taper off, and like we mentioned earlier, that bi-weekly, if you guys took advantage of that, you could pay it off in say about 18 years. Don't quote me on that, depends on your interest rate. Let's say you only say 5 years on it, so you pay off in 20 years. Then now your amortization will look like this. Okay? Now, at this point, I'm gonna pull out my calculator, which I don't have available to me right now, but let's say that 16 1650 times 12 is $20,000. So if you're going to save 5 years off your mortgage, that's going to be a savings. Thank you. So at 1650, let's see how close I got to my guesstimate. 1650 times 12 is 19,800. So pretty close, right?
Right.
Times 5. So it's going to be, your savings is going to be $99,000 if you guys took care of the bi-weekly mortgage. You don't have to do that. But my main thing is letting people know what their options are. But you see now why the bank really didn't explain that thoroughly to you, correct?
Correct.
'Cause that's money out of their pocket, money back in your pocket. All right. Also, if you pay off your mortgage earlier, guess what? You don't need mortgage protection for 25 years. You need it for less time. So it's less money you would have to invest in insurance also. Okay. Now, let me explain a couple things to you about mortgage protection. Mortgage protection has kind of changed over the years. It used to be kind of a one size fits all, but really there's two main options now. Okay? The first option is called mortgage payoff. Now what that is where you purchase a certain amount of insurance. Now what most companies would do is they would try and encourage you to buy 100% of what you owe, the 186. Do you know why?
More money for them.
That's how they make more money, right? In most cases, I don't recommend that. You know why? Because the only time you're going to owe 100% on your mortgage is right now. And now the benefits are level. So even if you got an amount that's a little bit less, the benefit is level. It doesn't match the balance of the mortgage like it used to. So why pay more for insurance than you need to? Okay? I would rather you, kind of like we talked about the three things earlier, put some of that money into debt, paying off your mortgage and things of that nature. All right. So what some people will do is get 75%, maybe 50%, whatever the case might be. Okay? Now, this is something else to think about. You owe, this is what we know. 2017, you owe $186,000 on your mortgage, right? Correct. Okay.
Just about.
Your current value of the house, how much did you tell me?
The value is 250.
250. And your equity is about $64,000.
Correct.
So if something happened to you right now, guess what the bank is going to be after? Do you really think they're after your house, the building? Because are they in the real estate business? You know what they're really after?
The equity.
This equity. This is what they want.
Yeah.
Okay? And their desire after your equity is only going to become more over time, and this is why. Let's say, you guys are young and healthy, nothing's going to happen, I'm sure, but let's say one of you, pass away in 15 years. Okay? We'll pick on Bob. Let's say it's one of you. Let me ask you this. What you owe on the mortgage at the time, will it go up or down? Down. So here we have this beautiful illustration. How much do you think you owe in 15 years on your mortgage?
I mean, at the rate we're going right now, I would say around about 140,000.
Okay. And by the way, just to break the role play for a second. Whatever they say, that's not what we're after. I don't care. I'm just gonna agree with whatever they say. Okay, so 140,000 in 10 years. What you owe. Okay. Let me ask you this: what do you think the value of your house is gonna be in 15 years?
Well, it should go up quite a bit.
What do you take a guess? Take a stab at it. I won't hold you to it.
At 300,000.
Okay, so 300,000. And I think those are kind of conservative numbers, so we're not acting anything crazy. But now, if you look at it, your equity would be $160,000. That's what the bank is after. That's why when one of you pass away, they don't send you a letter in the mail saying, "Oh, Shayla, so sorry, Vio passed away. don't worry about paying your mortgage payments for a while. The moment he passes away, you got 90 days. If you can't pay that mortgage payment, they're going to get the equity. Or let's say worst case scenario, both of you die. I'm sure you would want that equity passed on to your kids. If your kids can't pay it, the bank's going to win. They've already made all this money in interest, closing costs. Now on the back end, they're going to get the equity too. It's really not fair. So that's what we're trying to prevent. Would you agree?
Yeah.
So if it was up to me, instead of calling this mortgage protection, what I would actually call it is equity protection, because that's what we're trying to protect, and that's what the bank is after. So we're trying to do our best to make sure that the bank doesn't win any more than they're already going to win by making the interest on your loan. Okay?
Okay.
All right. So the second step of mortgage protection is called mortgage payment protection. Okay? What that is, let me ask you this, Shayla. I know we talked about it earlier. If VO were to precede you in death, what would be your plan?
Go and live with my parents, probably.
Okay. So you would sell this house?
Yeah.
Okay. Is that what you would want to do?
No.
Okay. What would you prefer to do? Why would you say that would be your option?
I can't see myself being able to pay the mortgage without.
So it's for financial reasons.
Right.
Okay. So most people, your scenario, in your 60s, mid 60s or so, you guys are still young and healthy, but in your scenario, most clients that I deal with really go for this option. For most of them, it makes more sense. It's up to you guys. But what they do is they typically will buy enough coverage to pay that mortgage payment, the $1,650, so that, I mean, let's go there for a moment. I know it's painful, but VO dies. First off, we don't know how you're going to respond emotionally, how long you're going to mourn, how long you're going to allow time to pass before you even want to deal with any of this, right?
Right.
You got to plan a funeral, you got to do all that stuff, and it's the last thing you're going to want to do. So that's one thing. But so you buy enough coverage to keep that mortgage afloat, so you can then put the house on the market. You'll have options, but one of the options will be put the house on the market, sell it, and then you get that equity and go on. You can buy a one-bedroom condo, whatever the case might be. Or another thing is, it may be just a matter of having that money long enough so that you could refinance and stay here. But you've got to keep that mortgage payment paid. Or maybe you want to do a reverse mortgage. I don't know. The point is, you're going to need time, because we've already discussed it, but you're going to lose a majority of your income when he dies, his pension, your Social Security, all that stuff, right? So what it is, and it could be whatever time period, maybe 2 years of mortgage payments. Some people will do 5 years. Some people will do 1 year. My main job is to help you qualify for the best thing you can get. But your main job is to make sure it makes sense financially, it fits within your budget. Does that make sense? Let me ask you this. If you at least had 2 years of mortgage payments set aside, would that set your mind at ease, Shayla, would that put you in a position where you don't have to go and live with your parents?
Yeah.
Okay. That would also protect the equity, correct?
Correct.
And that's our main goal. So let's talk about some numbers. Like I said, probably 85% of the people I talk to at your age will go this option. A lot of times it's cheaper and it's easier to qualify for. But we may look at one of these options. Let's look at the numbers, okay? I'll start putting those together for you. Hopefully that helps.